Yesterday we introduced the main issues of this seminar. So why the orthodox paradigm of economics was not able to detect and understand the crisis, how this paradigm was built under the Second World War, and how after the crisis of 2008 some strands of psychological economy attempted to improve it in the general framework of what we call the imperfectionist world. The idea that to understand the reality, we start with the GEE assumptions, so the assumptions of the general economic equilibrium, and then we introduce imperfections to explain why the reality is not very close to the conclusions of the theory. We explained that the main defect, so to speak, of this paradigm, if we think about finance, is that money is not part of the paradigm. It is introduced later on only as a device, a practical device to avoid the barter among consumer investors and so on. So finance is not micro-founded because the economic reality is based on use values. This means that it is based on not on money or profits, but on the exchange of goods to improve utility of the consumers. So finance, money is not very interesting. It's not something that is very interesting for the core of the economic paradigm. We explain how financialization and globalization changed the landscape of finance in the last decades, and we introduced the different trends, main trends of finance on a world scale. Now we start to use data, graphics, statistics to deepen the analysis that we started in the previous slides. So I refer to the slides number 23, that is the first one that has a graphic. In particular, we see the proportion of the UK banking sector assets, so the total assets of banks of the UK vis-à-vis the GDP. As you can see, this trend is basically, this proportion is basically flat until the 70s, when it started to grow. Then after the 80s and the 90s, it skyrocketed. And before the crisis, it was something like more than 500%. So it's obvious that you cannot explain this graphic using the classical paradigm of efficiency, because nothing can explain why in 30 years the banking sector should become 5 times bigger than before. What kind of service or of products the banks introduced that it was not there before? For instance, if we think about the telephones, of course, smartphones are a completely different business than the classical telephone of before, of the 70s or the 80s or even in the 90s. But this is not true for the banking sector. Overall, the banking sector, financial sector, insurance companies, etc., did not introduce real innovations for consumers in the last decades. We have the same loans, the same asset management products, the same payment system products than before. Of course, there are technological improvements, but nothing really new. So you cannot explain this incredible increase using something that is based on the product or efficiency paradigm. The second slide that we present is the different proportion of the CEO to worker pay ratio. As you can see, there is a slightly different but overall similar trend than in the previous graph, because we have a minor increase until the 80s, until the 90s. Then we have a boom. the relationship between the CEO to the average worker pay skyrocketed before the crisis. So financialization also meant an increase in the concentration of wealth and income as we proposed. Of course, it's not easy to demonstrate what is the cause and what is the effects, but these trends are common, they go together. The third graph is another demonstration of this trend because it depicts the income share of the top 1% of economic agents in the US and the corporate dividends as percentage of the US national income. And as we can see, you have a perfect U-shape figure. You have until more or less the Second World War a decrease. So due to the crisis, due to the New Deal, etc., all the policies introduced after the crisis and during the war, the concentration was reduced. After it, there was a period of 20 years, more or less 25 years, from basically the end of the Second World War until the 70s, when this trend was basically flat. And then after the 80s, we have a big increase of the income share of the top 1%, based, of course, basically on corporate dividends. This is the graph. This figure is about the U.S. income inequality from the 60s on. As you can see, the inequality goes up, but it goes up especially for the top 1 and top 5%. So from the 70s to the crisis, the top 5 increased his wealth, his income, by 900%, while on average the increase was a lot less. So this is another demonstration of what we said. Now, another point that we touched is the difficulties due to the globalization to differentiate the risk. How we can show this? In the first part of the slides, we have the synchronization of the markets around the world before the crisis. As you can see, the equity prices was very synchronized because for the advanced economy, in the years before the crisis, the synchronization was around 90%, so incredibly high. But also, if you look at credit, and it was very high because we are talking about 80-90%. So the 90% of change in the market prices of the country can be explained by international factors. But I would like to stress that even if you look at house prices among advanced economies, but also among advanced and emerging economies, the synchronization is high. We are talking about 50-60%. So basically, even in the house market, that of course it's local because normally a guy from Milan does not buy a house in London or in São Paulo in Brazil or in Johannesburg. He only or she only buys a house near where she or he works and lives. So normally house prices are not so internationally connected, but due to the fact that the house are bought using, of course, mortgages, and these mortgages are extended by banks that are connected among them, the financial markets also produce an increase in the house prices synchronization. This is an outstanding demonstration of the fact that globalization increased the correlation among markets. The second part of the slide is the change in the distribution of the yield credit spreads among 4 different asset classes: US investment grade, EU investment grades, and US and EU high yield assets. So we have 4 different classes, and as you can see, in the decade before the crisis, the correlation is perfect. I will say 95, maybe 98%. So basically, you cannot differentiate your risk using different asset classes, because the trends of these asset classes are completely connected. This is because what changes in the market, what drives the market, is not the micro risk of the different assets, but the overall trends in terms of liquidity, business strategy of the banks, and so on. That's why even after the crisis, as you can see, because the graph is from 2000 to 2015, even after the crisis, the correlation was very high. So only in 2011, this started to grow, to widen, because of the EU crisis. So when we think about the classical theory of financial portfolio, Markowitz, Fama, etc., we are talking about something that does not exist anymore on the markets. Because on the markets, this is the situation, a situation of a very high correlation among different asset classes. This is a graph about the importance of the pension funds on the markets. This is the total assets of the pension funds as a percentage of the GDP. As you can see, of course, they are higher in the US and UK, but they are increasing also in the other countries. So the pension funds now hold something like 90, 80% of the GDP in terms of resources. So they are very important as institutional investors. The graph after it is the composition of corporate equities in the US, of course, because the US is by far the most important financial market in the world. So as you can see, the households, that is the first part, went down a lot from the 70s to now. The direct ownership of corporate equities in the US by the families now, it is something like 35%, more or less. So the bulk of the ownership is through institutional investors, pension funds, mutual funds, life insurance companies, and so on. So the institutional investors are what is decisive for the markets, what decides how markets work worldwide. These graphs, that is the slide number 30, is about what we call the financial concentration. So the fact that the banks are concentrating, so the biggest bank in every country are becoming bigger. You can see in the first columns the top 3 banks in 3 different years, 1990, 2006, and the year after the crisis. Even for countries where the concentration was low, for instance, Italy, Germany, or US, of course, because their economy is bigger, so the concentration was less. You can see the change. For instance, in the US, the first 3 banks have a total assets of 8% in 1990 and of 43% in 2009. So a change of 5 times in 20 years. For other countries, it is a lot more. For instance, in France, it's 250, in UK, 340, more or less. And if you take the first 5 banks, you can see the increase. So the big banks for some countries are a lot bigger than the country itself in terms of resources. And even in the biggest countries, US, Japan, etc., the concentration is now a lot. This is an important graph because it depicts the trends of financial profits as part of the overall profits in the US. As you can see, the trend is more or less stable from after the Second World War to the 80s. Then it went up, and before the crisis it was around 50%. So the financial sector in the US made half of the profits of the biggest economy in the world. And this is incredible because normally profits are explained by the efficiency of the firm. So if you state that the efficiency is the cause of the profits, you are telling us that the efficiency of finance of banks is so high that even if they employ maybe 5%, 6% of the workforce, they produce 50% of the profits. This means that the workers of the financial sector are, I don't know, 20, 30 times more efficient, more productive than the other workers. This is a nonsense. Everybody that ever worked in a bank can tell you that this is not so, that they are not more efficient than anyone. Of course, the problem is another. The problem is the volume of financial markets. The volume of financial markets, financialization and so on, explain the boom of the profits of the banks. And of course, this is very relevant because profits in a market economy decides everything. If you produce half of the profits of the biggest economy in the world, this means that you decide basically everything in the country because you are powerful, you are in a powerful situation vis-à-vis the other firms and the other sectors, vis-à-vis the states, of course, the federal agencies, and so on. So this is a figure that synthesizes the situations of the relationship, so to speak, the balance of forces in the society. The graph in the slide number 32 is very important because this is the average rate of profits in the most important countries in the world. Of course, there is a very wide debate in the classical, in Marxian economics, and even in some neoclassical economists about why the average rate has a tendency to go down, and why this explains, for instance, innovation in Schumpeter, for instance, concentration of capital to resist the downtrend, and so on and so forth. There are also a lot of controversies in terms of data that are used to create this kind of analysis and so on. I only would like to underline that this is a very long-term trend, so it cannot explain something that succeeds in 1 or 2 years, but it explains the overall framework where innovation, competition, and the general market business strategies of the firms are created, because they resist something that is a tendency against them, the tendency to reduce the profitability of the investment. This is the basic trend of the society. This graph is about the interest rates in the most important economies on a world scale. This is important because, as you can see, even before the crisis, a lot before the crisis, many years before the crisis, the trend was to a reduction of interest rates. So the interest rates are going down at least since the 80s. Of course, this is due to the disinflation in the core countries after the oil shocks of the 70s, but it is also connected to the graphs that we depicted before, that is a downtrend in the profitability. If your investment is less profitable because the average rate of profits is going down, of course the interest rates are going down too with the general rate of profits. So this is a very important point, because if you have a long-term reduction in the interest rates, and this is a tendency, not because of the crisis, because the crisis only exacerbated this tendency, this means that monetary policy is becoming less and less effective, because monetary policy is effective in as much as it can move the rates to help or to slow the economy. But if the average interest rates are basically pushed down by more general trends in finance, this means that you not have the freedom, so to speak, to reduce the rates or to increase the rates. In fact, after the crisis, even if the economy, especially in the US, recovered, the rates went flat. And at every hiccup of the markets, they were pushed down. Why? Because the average, the leverage, the financial leverage of the firms, of families, of banks is so high that if you increase interest rates, the defaults will be skyrocketing. No one can absorb a big increase in the interest rates because it's simply too much for their level of indebtedness. So central banks are forced to keep interest rates down forever. You can be sure that at least for decades interest rates will be low, not only for the crisis but especially because of the high financial leverage. So monetary policy is forced to use other methods, what it's called non-conventional measures, quantitative easings and so on. Measures that are based on the quantity and not prices, because prices cannot be used. The price of money is zero forever. This is an important and not the last, the graph before the last one that we presented, because it's we have the Wall Street Dow Jones index in the 20s and 30s and today. Why we want to use this comparison between these two epochs? Because it's very, very telling. In the first part of the slides, you have the situation before and after the crisis of 29. As you can see, before the 29, we have an increase of many years of increase in the Wall Street, in the financial assets prices. Then we have the collapse of these prices. Then we have a crisis in the 30s, and only in the 40s and in the 50s we have a recovery. But this recovery was not very strong, because even in the 50s you could not recover the situation of the 29. So before you have an increase of the Dow Jones, a full recovery of the situation of the great crisis, you must wait for the Korean War. So 30 years. This is how much the crisis was strong, and how much the policies decided after the crisis, the New Deal, the financial repression, and so on, were able to keep down the market. In the second part of the slide, you have the situation today. The last two graphs that we present is one about the Dow Jones in different periods, and the last one about fiscal policy. In this graph, that is the number 34, we have the Dow Jones in the 20s, 30s and 40s, and the Dow Jones before and after the 2008 crisis. In the first part of the graph, you can see that the 29 crisis provoked a collapse in the Dow Jones, then a recovery, but this recovery was not full. In fact, at least until the 50s, that is basically after the Korean War, the Dow Jones was at a level that was not as high as in the 29. So basically the US stock exchange employed something like 30 years to recover the situation of the 29, of the crisis in the 30s. Why so? Even if, of course, the US economy grew a lot in this period, because of the financial repression. The New Deal, the Glass-Steagall Act, etc., created a framework of financial repression where the banks were kept in a state of calm, so to speak. They could not innovate, they could not exaggerate. That's why the Dow Jones reflected this situation in this way. In the second part of the graph, you can see the situation in the crisis of the 2008. A similar collapse in terms of the Dow Jones, but then a recovery that was by far quicker. And in fact, after some years, I would say 4 or 5 years, the Dow Jones went up, overcame the situation of 2008, and after 10 years, the situation is a lot better. So why this difference? The difference is not in the economy, because the economy in the 40s and in the 50s for sure grew a lot more than in this last recovery after the 2008 crisis. The question was the financial repression. The question was that after the 29, the profits of the banks, the possibility of the financial sector to grow were limited by very strong structural measures. On the contrary, after 2008, the DFA, the Dodd-Frank Act in the US, the Basel III framework overall in Europe, in the US, etc., all the measures taken to reduce the possibility of instability were not very effective in terms of profitability. Banks were able to recover the problems and to overcome them very rapidly. The last graph is about fiscal policies. Here we see the tax rate, the higher and the lower tax rate in the US. As you can see, in the 50s, when the US economy grew a lot, this tax rate, the highest tax rate for wage earners was about 90-80%. And only after the 80s it was reduced to then 60, 50, and so on. So you can see that the difference between high income people and low wage workers went from a very, very distant situation, something like 40, 50 points in the 50s and 60s, to the situation today, where the difference is 15%, maybe 20%. So this explains how the welfare state nowadays is a lot less effective to reduce inequality. So all these kind of graphs taken together, I hope that explains or help to explain the trends of globalization, financialization, concentration, and so on that we explained before. So in the graph, in the slide 36 and 37, we start to speak about, so to speak, an alternative way to look at the markets. That is the alternative of especially Minsky and other important economists. Good morning. I go on with our seminar about the financial crisis of 2008, the impossibility of explaining this crisis inside the mainstream paradigm, and the main financial trend, what we call the financialization of the economy on a world scale, with many examples that we did. And now we pass to an alternative, theoretically speaking, to this situation. A different way to look at finance, to look at banks, to look at money, and to understand what are the dynamics of the finance and economy in the last decades. So in the slide 36, we put the very famous book by Hermann Minsky, that in reality is a collection of a paper that he prepared in the years before, and is called with the name of the most important one of these papers, that is Can It Happen Again? Where it, of course, is a financial meltdown on a big scale as in the 30s. And of course, the answer is yes, it has. It did happen again after the 30s. This is important because in reality, if you read the book by Minsky, He is a bit confident, at least in the 80s, he was confident that the framework of regulation, monetary policy, fiscal policy, the overall general policy frameworks built after the war was able to tackle the build-up of a crisis. Later on, he was less confident because the situation changed. The development of the so-called money manager capitalism, the regulation and so on, created a different situation. This is why, as we explained, in the 80s, the crises were very uncommon. In reality, we had only one big crisis, that was the savings and loans crisis in the US due to the Volcker decision to increase rates to fight inflation, while in the 90s we had a series of different crises. Basically, every 2 or 3 years we had a big financial crisis, starting with the collapse of the EMS in Europe in 92. This, as I said, happened, and now we try to rapidly sum up this alternative framework. So the 37th slide is called Marx and Minsky in Pills, Part 1. So the first part of this alternative paradigm. The first point that we already touched is the fact that capitalism is based on profits, not on goods, not on consumption. Consumers are completely connected to production via marketing, via different psychological tools that are used to sell things, but anyway, consumers has no role in modern economy. That's why the orthodox mainstream paradigm is based on consumption, because it's not very useful to understand the real economy. So if we understand that modern capitalism, and in general capitalism, is based on profits, that is, on the accumulation of money, we understand that the economic cycle is based on investment made to increase profits. This means that what is important in capitalism growth is this cycle based on investment and uncertainty. Why there is uncertainty? Because no one knows or can know how much an investment can really produce in terms of profits. Investments are uncertain, but they are also forced. You cannot decide not to invest, because if, as a capitalist, you do not invest, you are doomed to fail by the competition. So you are forced to invest, but you are forced to invest in a situation of total uncertainty. This is very important also for psychological issues, as we will explain later on. The second point is, as we see, as we saw in the slide, that there is a tendency of the general profit rate to go down. So this decrease force the competition to innovate, because competition forced single investors, single capitalists to create new products, new process, new business models, and so on, to resist this downtrend. So the financialization is not something that is linked to the regulation, as many economists try to explain, but it's the other way around. It's the fall of profitability that force the capitalists to ask for the regulation, to ask for a new general policy framework. So financialization is the product of this deep trend in society. If we look at the more short-term trends, the ebb and flows of profits and of the profit rates is what explains the trends and the short-term cycle in a capitalist economy, including, as we said, the prevailing policies and regulations. So the economic policy and regulation is completely endogenous to the cycle. That's why we have cycles also in regulation. That's why economic policy is not able to reduce in this epoch the swing of the cycle, but on the contrary, it increases them. For instance, before the crisis with the so-called light touch regulation in the banking sector. In the slide 38, we go on with the explanation of all the consequences of what we said before. So, for the single investor, it is completely rational to buy a new asset, that is to innovate, because this new asset, this innovation, yields a higher return. So it is rational for him, but this induce bubbles, financial bubbles in the system, and beauty contest that, as we said, means herd behavior. Everyone buys the same assets because it yields higher return. That's the point. That's why we have bubbles, because everyone is trying to search the big deal of the time, that is the new assets and investment that is particularly good in terms of profits. But of course, when everyone buys this kind of asset, a bubbles goes on. The second point that Minsky explained very well in his writing about the financial fragility is that the financial leverage of investors grows with the bubble, because the credit flows to finance the bubble, because the collateral is going up, because the price of the financial assets is going up. So the situation becomes a situation where banks, firms, families, etc., have a higher and higher leverage to resist the situation, and at the end, they become what Minsky called Ponzi units. That is, units that rely to pay back their debts on new debts. They cannot pay their debts with their ordinary cash flows. They are forced to increase their debt. That's exactly what happened in the years before the crisis. Not for the single investor, but for the system as a whole. The debt was growing very rapidly because the assets were going up. So the very contradictory points of the financial system that Minsky was very able to explain in a very, very good way is that the system is at its most fragile exactly when it's at the peak of the bubble. So when everything seems fine because profits are good, investment are doing fine, everything seems perfect, this is exactly when the situation is at its most fragile, because the leverage is the highest, because the situation is based on the fact that the debt it's rolled over forever. Everyone is paying debt, doing a new debt. That's the main point. And this is a contradictory point, because one could say, well, if everything is stable, if everything is doing fine, what's the problem? Everything is fine. On the contrary, under the surface, the system is amassing contradictions in terms of leverage, in terms of Ponzi units, that is, units, as I said, that cannot survive without making new debts. So at a certain point, the bubble collapses. Why the collapse? Of course, we have many different specific causes for the collapse, but this is not important. This is only an historical point. The theoretical general point is that a bubble incorporates an assumption that is impossible to hold in a capitalist society. That is the idea that an asset, a sector, an investment can yield forever, can have a yield, can have a rate of profits that is structurally higher than the average rate of profits. This is not possible because when something is more profitable than the other sectors, investment goes towards this sector. So everyone is keen to buy these assets, this investment, this sector, etc. And of course, the bubble force the average rate of profit, the new rate of profits, that is the rate of profits, the profitability of this investment towards the average, because of everyone is buying the asset. So you see that after some years of the bubble, investments are so high that, of course, the prices in terms of profitability of this sector go towards the average. Let's make an example. When the Apple created the first smartphone, of course, the profit of this smartphone was a lot. But then many other producers start to create new smartphones. So the volume of this market grew immensely, but the profitability of the single piece, of course, went down because many other producers were creating this smartphone, etc. So, of course, Apple is a very profitable firm, but the point is that in general, the new sector profitability, due to the increase of the competition, tends to go towards the average. And at a certain point, this means that the bubble collapses. In the slide 39, we explain exactly this point. Competition is the key to explain the bubbles. Competition is a way to understand what is behind the functioning of the markets, because every single investor, every single capitalist try to increase the profitability of his or her investment, innovating, and this is what creates bubbles. So we see that you can explain a financial cycle in terms of bubbles and collapse without using psychological or biological explanations, as the behavioral finance does, even if, of course, there are many important psychological aspects in all this cycle, as we will see. But this is not the point. They are effects, not causes of the crisis. Another point is that finance and credit change the landscape of capitalist productions because they give to the system a lot more flexibility, because of course you cannot invest without credit if you do not have beforehand the funds, while with credit and finance in general you can invest, you can consume in a by far more flexible way. But it also means that the system is a lot more fragile, exactly due to the financial leverage. So the trade-off is this one: a more flexible and sometimes a more efficient also system, because you have external finance, but also a more fragile system. And the other point is that liquidity is at the very base of finance. This is important to point out because before the crisis, before 2008, liquidity was not considered an issue at all. If you read the regulation, financial regulation before 2008, liquidity was not even mentioned. It was not considered a problem. Liquidity was only a problem of price. If you are a bank and you do not have liquidity, just go on to the interbank market and you can find the liquidity. Of course, you have to pay for it, but this is only a question of price, not of quantity. On the contrary, with the crisis, a very important point came out. Liquidity is not something that you can have partially, that you can have for a single asset class. Liquidity is there or it's over. Liquidity is there for the whole of the market or it disappears. So liquidity is, in a sense, a public good. Of course, you have different asset classes with different liquidity. It's obvious. It's obvious that a government bond is more liquid than an ABS. But that's not the point. The point is that during a crisis, nothing is liquid. because no one trusts no one. That's the point. So liquidity, it's something that is linked to the trust, to the confidence that the investors have in the system, not on the specific risk of an asset class. Okay, this is the last part of the seminar, the last 3 or 4 slides. And before I conclude, I would like to point out that what I try to synthesize in this seminar, of course, as we cannot do this seminar in the normal classroom in the university, it would be interesting to discuss, of course, and to have and for me to propose some reading about what I said, because of course there's a lot of literature on the issues that I touched, and there are a lot of papers on the single aspects. So if you are interested in some points that I mentioned or in the general analysis that I proposed, you can ask me. In the last slide there is my email, and I will suggest you what I consider the best papers, books, works on the single aspects that I mentioned. So we explained that liquidity is paramount for the system, and it's a question of trust, not of the characteristics of the single asset class. And liquidity is basically a public good. That is, you cannot have liquidity for someone, you cannot have liquidity but for everyone in the market. This is very well explained in the 12th chapter of the General Theory by Keynes, and in general in the General Theory by Keynes, because it touches many times the question of liquidity on the markets. Of course, when everything is fine, liquidity is differentiated among the single asset class. If you have something that is less liquid, for instance, a house, you cannot buy or sell a house in an hour, but of course you can buy or sell a BTP, that is an Italian government bond, in 10 minutes when everything is normally functioning. The problem is when you have a crisis. And banks, when have a crisis, of course, are in a sense retrenching with their liquidity because they do not trust other banks, so they do not lend money to everyone. But of course, if the people start to take money out from the banks collapse. So everything at the end of the day touch the issue of liquidity, that is the creation of money, that is lending of last resort, that at the end of the day is the only tool that can stop a financial panic. In the slide 40, that is the last one on this kind of synthesis of the thought of Minsky, we have more policy issues. The first point is the role of central banks. Differently from the mainstream paradigm, in Minsky ideas, central banks do not control money supply, especially during bubbles, but in general, because money is created by banks doing credit. 90%, maybe even more, of new money is created by banks when they lend families, firms, other banks money. This is also acknowledged nowadays by many central banks. You have many important works on this issue, the so-called endogenous money paradigm, especially by the Bank of England, but more generally by many other institutions. So central banks cannot use their balance sheet to control very, very sophisticated money. They can only try to influence what the banks are doing. That's the point. That's why, for instance, the so-called Friedman rule, the idea that if you have a stable growth in the monetary aggregate, you can control money, it's completely a useless idea, because if banks think that it's profitable to give new credit, they will do it irrespectively of the growth in monetary aggregate. So the point is not what central banks do, the point is what banks do in terms of their loan policy. The second point is that due to this fact, monetary policy and banking supervision are very strictly interconnected. This is important to observe because before the crisis, there was a tendency to create separate regulators, separate supervisory authorities from the central banks, the so-called Twin Peaks model, especially in the UK, but also in other countries, because it was deemed more efficient. On the contrary, the crisis showed that at the end of the day, central banks and regulators are able to intervene in the markets and to tackle the crisis because they can help the banks in terms of liquidity. So if you do not have a balance sheet, as a regulator doesn't, because of course it's not a central bank, you are useless during a crisis, because the only thing that you can do is to speak, to talk about the crisis. Very good, but not very interesting facing a collapse. If you remember the very famous speech by the hence president of the ECB, Mario Draghi, the whatever it takes speech, well, this was made by someone that seated on a balance sheet of different trillions of euros. So when Draghi said whatever it takes, of course markets took him seriously. But if Draghi was only the president of a supervisory authority with nothing to throw to the markets to calm them, his speech would be of no effect. The second point that is very important in the Minskian ideas is the key importance of the cash flows. The cash flows, the real cash flows, the financial flows among the sectors, among banks, among operators, is a key to understand modern finance and in general economy. This is very important because once again, before the crisis, the idea of cash flows was not very relevant, was not even there in banking supervision. The importance was on the capital ratios, on profitability, on business models, but not on the point of cash flows. But at the end of the day, the cash flows decide what is going on. And if your cash flows are not enough to pay back your debts, you are forced, as we said, to do new debts. So the financial leverage is linked to the cash flows. You cannot understand the leverage and you cannot understand financialization without studying cash flows. The third point that we already mentioned is the fact that deregulation and more pro-business policies in general are not connected to some ideology that politicians have. Of course, they have their ideology, but that's not the point. The point is that they are needed in a situation of downtrend profitability. So if profits are going down, politicians have no alternative. They must help firms to do more profits. That's why the tax rate for firms goes down. That's why monetary policy is directed in a certain way. That's why there is the regulation and so on. So it's not sufficient to blame politicians or to blame policymakers for their inability to act in another way, because what they are doing is basically to taking into account what is the needs of the firms. Of course, you can state that this is not the point, that you are not interested in the needs of the firm. Fair enough, but it's another question altogether. What is the last point that we would like to make about this? What are the remedies? Well, first of all, the first remedy in a crisis, as we explained, is the lending of last resort. So at the end of the day, what calms down the market is the possibility for the banks to tap an infinite quantity of liquidity from the central bank. There is nothing that can stop a panic without lending of last resort. This is very important because, of course, central banks are there exactly for this, but sometimes, for instance, in Europe, we have uncertainties about the nature of the ECB as the lender of last resort, because ECB is the central bank of the whole of the Eurozone, so ECB is the central bank of every single country of the Eurozone, but as we saw in the case of Greece, this was not exactly in this way, because the ECB limited its intervention in the case of Greek banks due to some statutory limits, but that's not the point. The point is political. ECB was not interested in saving Greek banks because of the difficulties of Greek state and so on, what we know very well now. So for the first time in modern history, banks were refused lending of last resort by their central bank, that was the ECB. And of course, this had a strong impact on the Greek economy and a strong impact on the possibility of the Greek banks to withstand the situation. The second point that Minsky made is what he called the employment of last resort schemes. The idea that the state should provide a job for everyone that is unemployed. Why is very important this? Because Minsky explained that you cannot have a more stable financial system without having a more stable society. So in a society where unemployment is high, in a society where wages are low, and so people are forced to make new debt to live, in a situation and in a society where the welfare state is privatized, so the basic needs of the people, health, education, transportation, etc., pass through private markets. When the wealth is so concentrated, the instability is always behind the corner because of the general instability of society. So in the Minsky's ideas, lending of last resort and employment of last resort are in a sense a twin tool, are something that can help to gather the society to be more stable. Another very important point is the big governments, the idea that due to the strong financial leverage, the state must be strong to resist the crisis. So when someone attacked the idea of a big government, Minsky replied, okay, but if you want to dispose of big government, you must first dispose of finance, dispose of big banks. If you have very strong, big financial markets, very big banks, you cannot have a small state, because at the end of the day, the state will be called to save the banks. That's the point. So if you want to have a lower weight of the state on the economy, you should beforehand breaking up big banks. That's the point that, of course, is completely missed in the analysis of this. So our last point is what will happen with the next crisis. Of course, after 2008, we had a re-regulation wave, but nothing changed very much. Big banks were forced to accumulate more capital, to have more liquid assets, but at the end of the day, still big banks rule the world. Monetary policy is permanently expansionary. Fiscal policy is forced to a corner due to the big expenses to save banks. So, as Goodhart noted, the divorce is over because fiscal policy and monetary policy must work together. So, what is happening? How can we withstand the new crisis that is coming? We also have, after many decades of increase in the role of globalization, especially after when the China entered the WTO, with the election of Trump, we had a symptom, a clearly realized symptom of the crisis of globalization. Phenomenon like the Brexit, like Trump or other election in the last years marked this crisis. Globalization now is considered not only a good thing, but also a development that has many drawbacks. Of course, the reaction to globalization is very confused because it's very difficult to think to another alternative, to a completely different way to develop world economy that is not globalization. So we do not have an alternative. For sure, Brexit or Trump are not proposing, are not inside a different paradigm, because this paradigm is not there in the productive process of modern economy. But they are a symptom of the crisis of globalization. And this is very important because, of course, globalization is what marked the last decades. So, what will happen with the economies and the next crisis? Here we enter the last point that I would like to touch, that is the connection, the real connection between economy and psychology. In the last part, I said that there was the last part, but it was not, of course, because the things that I would like to touch were a lot. So this is the final part. So we explained the alternative posed by Minsky, and that are partially based also on ideas that are coming from a Marxist tradition, especially via Kalecki and Rosa Luxemburg, because Minsky borrowed a lot from Kalecki, and Kalecki borrowed from Rosa Luxemburg. But in general, this alternative is based on the idea of profits, of money, uncertainty, and so on. We also explained the policy framework that is connected to these ideas, and we also explained that after 2008, the situation did not change a lot. Of course, there were some, how to say, returns, something that went back from the dustbin, as the analysis of the liquidity risk in banking regulation, the so-called macroprudential rules, the analysis of the systemic risk. But at the end of the day, the business model of the banks did not change a lot. The role, the general role of the financial markets and of big banks in the financial markets is still there. So what will happen with a new crisis? I would like to touch some points, a couple of issues on this point. The first aspect is that after a crisis, we always have a so-called Minsky moment. That is a period where the ideas of Minsky and even of Marx are taken seriously. The point is that this moment is not very lasting. In fact, in the last case, in 2008, it only lasted, I would say, some months, maybe a year. After a year, everything went back to business as usual. So, imperfectionist word, as I called it. You have the GEE hypothesis, you have a word that is not as perfect as the hypothesis suggests, so you have to find imperfections to connect the GEE word to the real word, and that's it. In the universities, you still have the teaching of the old paradigm with something new. So nothing has really changed. And if you look, for instance, at the Nobel Prize after 2008, for sure this is completely confirmed. The second point is this issue. Do we stand for pluralism? Of course, pluralism is a good thing. So if in the university you also teach the Minsky's ideas or other heretical ideas, besides the normal, ordinary finance or economic theory, that's good, of course. People can enjoy them,
and students will be more prepared for the crisis. But that's not the point. The point is not academic. The point is in the policy making. Because, of course, for a university, it's very easy to include pluralism. It's sufficient to create new courses. It's like, I don't know, biscuits on the supermarket. You can have 5 kinds of biscuits, 10 kinds of biscuit, 25, 50 kinds of biscuit. That's good. So in the university, you can have not only, I don't know, 3 courses on finance theory, but 4, 5, 10. That's good. But that's not the point. The point is when you have to decide. You cannot have pluralism in policymaking. Let's take an example. A central bank has to decide what to do impending a crisis with interest rates. How you can implement a pluralism? The Monetary Policy Committee can be composed by different economists with different background, but at the end of the day, they must decide. They cannot decide pluralistically. They cannot say, well, for a monetary perspective, you must raise interest rates. From a Keynesian perspective, you have to put down the price of interest rates. From another perspective, you can do another thing and so on. You cannot do like this. You have to decide and you have to put up an option. So pluralism is not a real solution. As I said, it can be interesting for the university. It can help students, but that's not what really changed the situation. The last point that I make is what is the role in the economy? If we understand, as I proposed, that economy is not very interesting for how the real productive process, the real business cycle is going on, because it has nothing to say very interesting to these issues, how can be useful for the system, how economists can help society if they cannot say nothing interesting on the real issues. Well, the point is once again marketing. This is the real connection between psychology and economy. I already proposed this idea when I proposed the slide with the O.J. Simpson legal squad and women that was smoking. This is how marketing works. Marketing works because it's able to sell things, and that's the point. Economics is able to sell things. Literally, economics is able to convince people that everything is fine, the invisible hand, everything is stable, so just go on and buy things. That's what is your civic duty as a good citizen of the society: to invest, to buy things, to work, to have a wage, to use it to buy new things, and that's it. So economics is very important as the how to say, the spinal cord of the system in terms of marketing. And if someone says that this is not a science, well, it's very difficult to reply, because what is a science? Something that is connected to reality. It's very difficult to, in modern times, to analyze the connection between reality and science. It's difficult even in physics, let alone for social sciences. So that's not very interesting as a point. The very interesting point, on the contrary, is what the famous psychoanalyst Jacques Lacan called the master discourse. That is, the idea that the master of a process is not interested in how things work, provided that the things are going fine. When everything is fine, no one is interested in understanding how things work. That's exactly the point of invisible hands. The metaphor of invisible hand, that is the metaphor of the whole of the economic discourse in the last 200 years, it's exactly this point. When economy is doing fine, there is the invisible hand. There is the idea that things are stable, financial markets are doing fine, banks are efficient, and so on and so forth. This is the real role of economics in modern time, the master discourse, the idea that you must not be interested in how things works because they are doing fine. And when the crisis struck, economics is not very useful, because policymakers know exactly what to do. In 2008, if you read the different ideas of economists on how to intervene in the crisis, they were all completely ineffective, are completely non-operational. They could write articles, many were completely useless, many were completely destroyed by the events even after some weeks, but that's not the point. Central banks knew exactly how to stop the crisis, lending of last resort, throwing trillions of dollars, yens, euros, pounds into the markets to stop the panic. They were not interested in the academia ideas on the crisis, because that's not the point. Academia is a marketing tool. It's not an operational tool. It's a very different business. And I'm not stating that this is not important, the one business or the other. I'm only saying that there are two completely different businesses. And policymaking is in the business of stopping the crisis. Economic theory is in the business of representing the invisible hand metaphor. This is the last point that I would like to underline. So the whole of the psychological economy, the whole of the analysis of psychological behavior, biases, etc., in the financial markets and in the economy as a whole is interesting only inside this framework, the framework of the master discourse, the idea of the invisible hand metaphor. This is inside this framework that you can understand how, for instance, the cognitive biases or the emotional biases of an investor, of a consumer can be understood. So these are the ideas that I would have been important for me to touch in this seminar. Of course, I understand that it's very difficult to even for me to explain this without having a direct confrontation with the public. So I apologize if sometimes what I said has been not clear, if there have been a repetition, etc. But as I said, if there is something that the people that will see this seminar are interested in having a discussion or a clarification or comments, please write me and we can discuss in this period that is not possible to do it live at the university. We could manage to discuss the things at least via email or other IT devices.